Good morning, everybody, and welcome to the Prosperity Through Multifamily Real Estate Investing podcast. We're so glad you tuned with us this morning. We have a very special guest returning back to the show. But as always, I'm your host, Cody Laughlin, and joining me this morning is my co-host, Mr. Brian Alfaro. Brian, good morning.
Good morning, Cody.
How are you, my friend?
I'm doing well. Excited to have Mr. Bill on the seat today.
Yeah. So Bill Ham, a great friend of ours, I've known him for a little bit now, and our first return guest on the show. And so, Bill, before we get into your story, I'd like to encourage the listeners to go back and listen to episode 14, which we released in May of 2020 last year. And it was perfect timing because it was just in the onset of this COVID pandemic and a lot of big question marks in the marketplace. So really excited to have you back and talk about kind of what you saw last year and what you've had going on.
Yeah, appreciate it. Thanks for having me back. Always a pleasure. I think we went through some predictions back then and kind of what I thought would be coming up. And I think I was relatively accurate, a little delayed on a few different things. I'd actually have to go back and listen to the podcast myself to remember exactly what I said. Maybe you can remind me. But I know back then, I believe a lot of the major concern, COVID was new. One of the big fears in real estate and multifamily was that we were headed for a rent cliff. Oh my gosh, everyone is about to just quit paying the rent and, going to be a giant crash in the market. That didn't occur at that point. And I'm still kind of predicting that we may see some of those things. But we were a little bit wrong in that regard. I think the compassionate capitalism plus stimulus checks and things like that done by the government really kind of floated the boat for a while. That being said, fast forward, now we're starting to see some of the things that I predicted. So I think I was accurate in a lot of my predictions, just a little bit off in the timing of when some of these things would actually show up. But definitely not a crash in the values. Prices, that hasn't occurred. I still believe, and I did then, that a lot of real estate deals are overpriced by about 20-25%. And I still think that we're going to see some decline in there. I've adjusted my metrics on some of that now, but I believe that's some of the things we went over back then. Anything else we can add to that?
No, man, that's pretty much dead on. I think, like I said, we spoke in April, we released the episode in May, and you're absolutely right. We were having a lot of those question marks about, collections, and every month it was like, okay, wait till May, okay, wait till June. But it never came, right? Everything just kind of collections pretty much maintained and rode out steady for most people. And then, like you said, everybody was kind of waiting on that big correction, right? That big change drop in the market, and nothing. If anything, it got worse, right? It just continued to get more and more competitive. You saw all this liquidity flooding into the market, and and I would tell everybody it made things more competitive even post-COVID, quote unquote, than it did pre-COVID. To your point, valuations we're still seeing it today. It's just crazy where some of these assets are trading at. But
well, now I'm just doubling down on the things I told you last time. Basically, exact same stuff. I'm exaggerating most of my opinions now. So on the rent cliff, we were wrong in the timing, but not in its occurrence. We're here now. And it's a very unfortunate scenario. But if you start looking at the news, now it's in CNN, it's in the Wall Street Journal. Major headlines hitting where the last one I read, we were around 20% of the renter base in America being at 60 days or more in delinquent rent. So that is a rent cliff. Perhaps, the government will save us in some manner, stimulus, cancellation of rent or cancellation of our mortgage. I don't know. We can discuss that like all the talking heads on the news forever. But at the moment, I am analyzing deals weekly. I'm not on the sidelines. I'm very active. I'm looking for properties. That being said, I'm being forced to the sidelines because I'm not paying prices that people want. And we can kind of discuss, I think that's an important topic, because what we saw last time was I was saying, hey, there's overpricing in the market, and we're seeing some things that I think are not really good fundamentals. Well, that's only gotten worse since then. It didn't get any better. And now I'm really telling you the fundamentals have left the market, largely speaking. And I think a lot of that pricing is highly exaggerated now. And we can discuss why, and I've got sort of math to back that up. But basically, I think between the rent cliff that we are facing now and the overpricing, there's some issues in the market coming up, and that's going to lead to an interesting market cycle over the next 2 or 3 years, and we can sort of discuss what that'll look like. But yeah, basically that rent cliff has shown up now. I'm again, like I said, I'm analyzing deals. I didn't finish that thought. I'm analyzing deals weekly. And what I'm seeing is that minimum 10% delinquency, 20, 30% in some assets, mostly in the C space, the affordable housing space, a little bit in the B space, not so much in the A's. If you're analyzing A's, you might see rent softening in the A's, maybe some concessions, but the collections there seem to be fine. That's a less financially affected, more affluent demographic, renter demographic. The more workforce demographic that has been hit harder by layoffs and decline in the economy, they are now starting to struggle with rent. And again, just go pull a few rent rolls out there and you'll see it. And I'm so as an operator, and I've been in this business, for those who don't know me, I've been in the business for a little over 15 years now. Own a management company. I've been operating all my assets. I've been involved in thousands of assets. I haven't owned but over 1,000, but I've been managed and involved thousands. And through a lot of experience, what I've come to realize is when a tenant gets about 60 days delinquent, they tend not to recover. If you hit that 60-day delinquent mark, that usually in traditional operations means that's an eviction. So I'm kind of saying that we're seeing a solid 20% of the average tenant base that's now facing potential eviction. Obviously not because the eviction moratorium has been extended. So these are not people that are actually going to wind up being put on the street. But as owners and operators of the assets, they're not paying the rent. So that's a toughie, and that's also where this is going to really rear its head is when the seller needs to exit. Mm-hmm. And you want to go and buy that property and you take this rent roll over to the lender and the lender says, yeah, right. Hey, these tenants aren't paying the rent, because remember, lenders are always going to lend on a debt service ratio. That's the sort of holy grail for a lender. Most lenders are always and always have been at about a 1.2 or 1.25 debt service ratio. Well, with this delinquency that I predicted just inaccurately in the time frame, now it's here. It's about to start really damaging the ability to borrow money against these assets. At the same time, we're seeing Fannie and Freddie and a lot of lenders start to back up, starting to tighten up criteria. They're starting to have a flight to quality. I'm sure we talked about that last time, and they're doing exactly what I predicted they would do. And I know this because, one, I study market cycles. Number two, debt always kills the market. It's an easy prediction. It happens every time. Lenders start to back up. They can see ahead. They say, oh gosh, the economy's going into recession. They quit lending, causes a recession, so forth and so on. So it's somewhat predictable. But we're seeing a lot of the things I think that I predicted back then. I was just a little off the time frame, but they're happening now. And so now my prediction is we're going to continue the market cycle as we always do. Markets will decline. We'll go into a recession. We're already there. There'll be some pullback in pricing, in operations and things of that nature. How much of a pullback? Okay, that is certainly debatable. I would say in some cases, none to maybe to only a little, because of inflation, because of money coming into the market, because a lot of private capital seeking tangible assets. Hey, if these guys on Reddit keep screwing around with the stock market, I think we're really going to see a lot of money coming over here to multifamily, for better or for worse. But you can really kind of watch that as a metric as well. If the stock market gets real squirrely, people will, out of fear, they'll jump over to tangible assets. So we may see some buoying of the market and its values through that model of inflation going forward. But that's sort of to be determined. Tenants not paying rent's a real issue. That's going to make it tough, and it's going to make borrowing hard and buying hard. So we'll see how that turns out. Yeah.
Man, you brought up so many great points, and I want to kind of go back and digest some of those. The first one, as with many market cycles, and particularly in the past, probably 24, 36 months, you've had this division of philosophies, right? You have two sides of the fence. So you have this one side that people believe, hey, look, the market's going to continue to appreciate. We're going to continue to ride out, like you said, we have inflation coming, like things are on the rise still. And then you have the people on the opposite side of the fence who are like, man, it's doom or gloom, or oh, there are corrections coming or whatnot. I think obviously we kind of know your position, and, having you spoke on this several times before, but kind of talk to us a little bit more about, why do you feel that there's still some positive outlook from a lot of people in the market? Because, again, if you look at the way some of these assets are trading at, despite the fact that we're seeing increased economic vacancies, increased delinquencies, why do you still think that we're still seeing this competitiveness in the marketplace?
Because I think human nature is to basically do something until you can't do it anymore. Not that it's a good idea, not that fundamentals exist. It's we're going to be right until proven wrong kind of model. And so I think a lot of people don't stop and back up and look forward and predict the future well enough. And so they just keep doing whatever it is they're doing until they're forced out of it. Well, at the moment, that's just buying and bidding. Hey, prices are high, so let's just pay a little bit more, and let's pay some more, and let's pay some more because everybody's charging more. And it kind of becomes this herd mentality. And that's where I'm kind of pointing to a lot of the market now going, ooh, be careful, guys. It's starting to change. So one, I think that there's going to be a somewhat of a split recovery. And we hear about this in the news a lot. I've discussed this in the past. I think where you will see the inflationary prices is in the A and the B space. I think the C space is going to fall apart as far as value is concerned. And the reason that I say that is a lot of the money that's sitting on the side that may be considered as inflationary money is money that's opportunistic funds and money. It's looking for a value add deal. It's looking for the market to crash. It's looking for the disruption so it can jump in there and purchase these aggressive assets, which means it's not dumb money. It means it's looking for a good deal. Well, in the C space, we have what I keep talking about and I keep saying is the CapEx tsunami. Hey, the 1960s and 1970s buildings that were built in the 60s and 70s are aged now. Things are reaching their physical obsolescence. And what I think we're going to see in that affordable housing space is people starting to figure out the cost basis is out of line. If I buy the property and then I go in and actually take care of all the interior structure, the plumbing, the electrical, the upgrades that need to be done to these old buildings, the roofs, the stuff, which by the way, you're not really going to charge more rent for that. That's just, you're just putting that money into the building. And so the purchase price plus all of that work that needs to be done, that's not really going to generate revenue, is our cost basis. That's our total dollar in that building. And I think what you're going to find is that when you take the purchase price with today's inflated prices, plus this capital expense that people are turning a blind eye to, when they stop turning a blind eye to CapEx because the plumbing literally blew up and the roof fell off and things like that, all of a sudden you're going to realize everybody's overpaid for the C space. When the value's there, you're not going to be able to get anything out of it because the purchase price plus renovations is going to take your cost basis above appraisal. Nobody's going to do it. Lenders aren't going to let you do it. They're going to start demanding, reserves, high reserves for these older buildings. And that's why I'm predicting a softness in that space. Supply and demand. Yeah, supply and demand is still there. I mean, the affordable housing is definitely in demand. Rents are holding, but at the same time, those buildings are going to get old. And that's where you're going to have a lot of trouble. Code enforcement, the city, NIMBYism, not in my backyard. These people, this kind of stuff is going to come down on the landlords to really keep those buildings up. And it's the right thing to do for your tenants, but it's not going to be the most profitable thing.
Yeah.
And that's what I'm kind of saying. Watch out for that C space. A's and B's, I think you're going to have a lot of inflation in there for a minute. And then I think you won't, and I'll tell you why. But yeah, go ahead.
Yeah, no, I was just going to agree with you. I mean, I think it's like you said, it's going to cost you so much more money now because the buck has been kept being passed and passed and passed and passed. All of these properties have been turned over so quick. Right. And so you go back and look at the history and on the deed, and it's like, man, it's turned over like 20 times in the past, 15 years.
Right.
And what's interesting is it's intriguing to me that we haven't really discovered that price discrepancy yet, right? Because with the cap rate compression, I mean, in some markets, ours and particularly the ones we're focused on, you don't even have 100 basis points in between the cap rate spread between A class and C class. Correct. You know what I mean? So people are buying these properties at the same cap rate almost that you could buy an A or B class. And it's intriguing to see the behaviors in the marketplace over the past several years. And I think a lot of it, just like you mentioned to earlier, was so much more liquidity coming into the market, so many more unknowns, whether it be the stock market, whatnot, that's coming in and wanting that as tangible assets. it's made it it's made it very hard to stick to the fundamentals, because like you said, it's what are the fundamentals now?
Well, and that's my ultimate prediction here. What are the fundamentals anymore? And that's why I'm thinking that we will ultimately have a pullback. Yes, there could be inflation. Yes, there could be flight to quality, tangible asset, all the things I already mentioned. Agreed. But the properties don't make money anymore. Are we good with just not making money in real estate anymore? I mean, okay, great. I love this. Let's buy real estate with no real fundamentals by valuing the property on cash flow. Let's do that. Perfect. Every deal is a good deal. Then don't worry about cash flow anymore. So every deal is a good deal now. Let's just go buy real estate. Hallelujah, man. That makes my job awful easy. If we can just go buy stuff and it's 2% cash flow and we're good with that, I love it. I think that's absolutely absurd. Mm-hmm. But I think that's kind of what we're looking at in the market right now is people are buying properties with only on pro forma, only on projection. And basically, I teach and I've worked with you guys and I've worked with a lot of students, a lot of people that are new to the business. And what I'm seeing right now is a lot of people are basically analyzing a deal and they're more or less saying, hey, this deal sucks, but that's okay because I'll raise the rent. And as soon as I raise the rent, the deal won't suck anymore. I think that is a complete departure of fundamentals of real estate. You're saying this is junk. These numbers flat don't work, but I'm going to go ahead and reward the seller because there's nothing else to buy, because everybody else is doing it, because this is the market, and we all have to get up and go to work each day. And that's why I kind of made that comment that humans just keep doing the same thing over and over until they're stopped forcibly somehow, which is why markets always cycle up and down. You're just going to keep doing the same thing until you can't. And that's why I'm saying that's what I'm seeing. The fundamentals are leaving the market. When you're buying properties at, cap rates that match the interest rate, there's not even any spread there, and so you're overpaying for these properties just because you believe that you're going to be able to raise the rent. Well, I'm telling you, going into a recession cycle, that is an extremely risky business model. And that's one area that I think we're going to see a big pullback is when a lot of the syndicators, a lot of people in the world out there realize what's happened. They've overpaid. They were planning on getting giant rent increases. They're not. By the way, there's 20% of the tenants not even paying the rent, let alone you're going to increase rent on them. And then they're going to say, okay, well, this didn't work. We'll just go ahead and sell the property. Oh, by the way, you got a 10-year Fannie Mae note. That's $1 million defeasance. They didn't tell you that. And now you're trying to sell the property. Now it's a loan assumption. And we're seeing this problem. It's like half the deals out there, you've got to assume the mortgage. People don't like loan assumptions. You got the wrong debt. You're trying to exit early. You got bad debt service ratio. All of these things are pulling the pricing away from good old fashioned fundamentals. And that's why I'm predicting, regardless of anything the politics do, the stock market or anything else, we're going to see an ultimate decline because real estate just doesn't really make much money at these prices. It's turned into a giant mattress that people are just going to stick money under. And that makes, as a syndicator, sure, if none of my people want to see cash flow anymore, hallelujah. It makes my job awful easy. I don't think that's going to be the case. And that's why I really think that all of the asset classes will have a price decline. When, I'm not exactly sure. I'm predicting within another year or so, you're going to start to see it. And that will move us into another market cycle, which is why I wrote the book and why I brought out information that's going to be very applicable for the upcoming market cycle.
Yeah. Looking forward to getting to that. We're definitely going to make sure we touch on that here in a little bit. But I want to go back to a point, when you're talking about these, in this particular time right now, we're seeing people underwrite on pro forma and such like that. And look, ourselves included, we've had to look at deals to do that, to see, if it's a good market, if it's a good sub market, a great area, that seems to be the only way that you can have any type of competitive advantage. That's the only way you can underwrite.
Agreed.
So I want to kind of ask you though, with these market cycles, we know that market cycles are different from market to market. What I'm experiencing here in Houston, you may be completely different in Atlanta, Georgia,
correct.
Right? So in speaking to that, do you see some of those fundamentals being different in areas like primary markets that are attractive, that have great migratory patterns, great job diversity, all the fundamentals when we talk about looking at a market? Do you see that being a little bit different versus if you were in a secondary, tertiary market?
I see the probability being different. I don't see the fundamental of the business model being any different. what you're saying is, hey, if I buy a property and I know I'm overpaying for it, and I believe that it's going to be okay that I'm overpaying for the asset because I can get rent growth here. The question is not, can you get rent growth in or out of town? You're right. It's how much rent growth are you going to get? I think everybody will get some. Are you going to get enough that justifies the price you're paying? That's the question you're asking. And yes, that could be very specific to markets. Clearly, migration patterns, clearly, population patterns, things like that have a lot to do with that. So yeah, I would say generally speaking, you're a lot safer with that model, the closer to the core of a market you can get. So yes, I would say your rent, let me say, I typically think in over the last 100 years or so, yes, that's typically been true. You're safer in core markets. As of this afternoon with COVID, man, we're actually seeing some of the suburbs become a little more pricey than core markets. I don't think that's a trend that's going to last forever. I think that you will still see, you are still always going to be safer in your core market. I still don't think that you should say, well, I'm in a core market and we're having good population growth and we think we can get rent growth. Therefore, let's purchase an asset that really doesn't make financial sense today because we're going to wave that magic rent wand and then poof, it'll be a good deal. I still think the fundamentals of that comment are incorrect.
Yeah.
Well, those assets.
And you know what else is interesting? You mentioned debt, right? And one thing that we're also seeing right now, which we haven't spoken on yet, is this low interest rate environment, which I think is giving people more flexibility into going, they can now afford to pay more, getting away from that fundamental though, right? It's not, if you're looking at 5 to 7 year hold right now, we know that rates are going to be low for, let's say, the next 2 years. I think the Fed has pretty much made that statement, but what happens in year 5 and year 7 when your rates start to creep back up? Right now you're underwriting. I know for us, we're looking at maybe a reversion cap rate that's 50 to 100 basis points higher than where we're going in at right now.
Safe. Yeah.
But the question is can you rely on that? You know what I mean? What happens if it jumps up to, back to where we were pre-COVID? It completely diminishes the value of the asset, right?
It could, yes. And so again, if you're getting a fixed rate mortgage, and I really kind of go through a lot of this in a lot of my teaching, but if you understand the market cycle, you understand about where you're at in the market cycle, you can roughly predict where you're going to need to exit that property, meaning loan term. So if you went out and got a 10-year fixed rate mortgage today, you're pretty safe. I mean, you've got 10 years of market cycle up and down. Your interest rate's not going to adjust, even if they blow the interest rates up. So I think that's a safer strategy, doing something like that. But then you're stuck in that deal for a long time. So it really depends on the exit strategy, depends on what you're trying to do. I think people overvalue interest rate when discussing real estate. And I think the catch is you look at this and you say, well, gosh, what a low interest rate environment. Yeah, but are you finding deals that make any sense right now, financially speaking? No, it has nothing to do with the interest rate, does it? Because all we're doing is shifting that value straight to the seller. So what the interest rate is if I have to turn around and overpay for the asset and over borrow, and my loan to value isn't great. I'm bringing all this cash to who cares what the interest rate is? You're still overpaying for the asset. So that value transfers basically to the seller in that regard. So that's why I say it's not that big of a deal on interest rates, number one. Number two, yeah, but they're tightening up the terms behind the interest rate. And there's the illusion. And this is where you got to kind of watch debt, especially agency debt. They're very politically driven and very politically forward facing. So they'll sit there and say, oh, we're doing affordable housing and we love you guys and all this kind of stuff. And look at our low interest rate. Yeah, but over here, when you get into their office and you're actually in loan application and committee, you're going to find out those terms have tightened up. The loan to value is less. The criteria for borrowers is greater. You've got to have more of a resume right now. If you're brand new to real estate and you go and look at a 100-unit apartment complex and walk into, try to get a Fannie or Freddie loan, good luck. You're going to have a pretty decent team behind you to pull that off. Flight to quality of asset, their loan to value, all of the terms are tightening up dramatically. But hey, look, the interest rates are low. And I'm sitting there going, so what? That's semi-irrelevant. Hey, the emperor has no clothes here, and then it's just not that big of a deal because, as I point out, because the interest rates are low, that means you're just finding all kind of great deals that cash flow to the moon, right? No, it's because of the pricing. And that goes back to the fundamentals. These assets at these prices and these cap rates don't really cash flow. They will someday. And what I think the mistake everybody's making here is that they're looking at the last 5, 6, 7 years. And they're like you point out, Cody, everybody's owned that building for 15 months, maybe 24 months. They're selling, they're making 30% return. The 2 years is about to turn into 7 or 10 to get that same return. You're going to have to decompress that cap rate. And if you're buying that thing to 3 or a 4 cap rate, that's a lot of decompression. Well, how do you decompress the cap rate? Raise the rents. Well, okay. So what if you can only raise rents at 4 or 5% a year, not the 10% you analyzed? Well, then you're doubling your whole time. It's fine. You'll make all the money you plan to make in 10 years. Oh, did you get a 3-year mortgage? Oops. There's where we got to watch out. See, that short-term debt can force us out of a deal in an off cycle. And that's why I'm super big on market cycles and the debt and strategizing your debt and timing it with those market cycles. Because right now you're going to be in for a long hold if you're overpaying. It's a sin that will correct itself. It just takes time. You think you're going to flip out in 2 years and make $1 million. Careful.
Yeah. Well, and the key to that as well is being capitalized enough to be able to weather that storm. If you're going to exit in year 2 or 3, or you hoping you are, but then you end up holding it for 7, you got to make sure that you're capitalized enough to last that long. Because if you didn't account for all of those extra expenses from holding it for long, you're going to be in trouble. And
that goes right back to my CapEx tsunami. So it circles right back around to that. And that's where I'm predicting a big upset in the market coming forward, is that the hold periods are going to be lengthy. And in the C space, those buildings don't have that much time left in the asset. And somewhere in year 3 or 4 or 5, you're going to be in there really doing a lot of capital expense injection into that property, which right there is going to mean zero cash flow. So now you're in an older building, you're working for a living, you're dealing with an affordable tenant base. You're dealing with the city that's probably getting on top of you because that building's getting old and the tenants are complaining and you got leaks and this, that, and the other, and you're not cash flowing and the debt's not there to exit and you got a long-term loan. It's kind of an area that I think is going to get people in trouble as far as value is concerned. I know all that sounds negative, but I do have a solution for all of it. But yeah, that's kind of my general prediction, is that these buildings are getting old quick, and it's a problem that's never occurred in American history before. We've never had this much infrastructure age at this point. It's never occurred. And so I think it's one of those things. It's just out of sight, out of mind.
Mm-hmm. Yeah. Interesting one. And you alluded to one point earlier. You made this prediction to us last year offline. It wasn't on the show in our recording, but you did make this comment. You said, listen, it's going to get harder for new experienced operators to come into this space. And you just pointed this out a minute ago, where from the debt side, and we're seeing this ourselves, is when you go and start sizing up a deal from the debt side, the number one feedback they're looking at is, what is your track record? What is your success? And as you said, they're tightening up on all the other terms, but they really, really want to see that ability to perform. And have you been through a previous cycle, or have you been through a downturn? And that's becoming more and more pivotal. So, for anybody that didn't catch that or didn't hear that, listen, you got to go align with the people out there that have success, and really partner with them and make sure that, you're not trying to fly solo on this, because we got rocky roads ahead for sure.
Yeah, absolutely. So. Yeah, that's what I'm predicting. It's normal. It's not the end of the world. It's not a major crash. It's just a market cycle. We went through it in 2008. We'll go through it again. We go through them about every 10 years. They're quite predictable. You just need to learn what to do and how to adjust, and then you'll be fine.
Mm-hmm. So Bill, talk to us then. This has been great conversation. Obviously, this is a lot of chatter that goes on through our community, but what about on the investor side? Your database, the people that have invested with you prior, how are you educating them? How are you kind of keeping them abreast on where you are as far as your philosophy, your outlook on where the market's going to go? Talk to us a little bit more about that.
Yeah, we're trying to really let everybody know that the assets they've invested in are quality assets, and that even if they aren't producing cash flow, which 2 are and 1 is not at the moment, the one that is not cash flowing at the moment, it's because it's not because the property isn't producing positive revenue. It is. We're storing up reserves. We want to kind of have reserves in the background. So we're producing revenue. It's just we're not currently distributing it on that one particular asset. But as again, we update all our investors. We keep everybody current on what's going on and what we're doing. And going forward on a deal, I'm not currently working on any projects, but if I were, and if I were one of you out there, I would be educating your investors on the potential lack of cash flow. And so two things, the potential lack of cash flow and the hold time for the project. So what you really want to be kind of trying to sell right now, if we want to call it that, I think is your tax benefits. Be doing a cost segregation. If you can, make sure you're maximizing your investors' tax benefits. That's a way to sort of bring more value if you're not cash flowing heavily. Plan on maybe soft cash flow for a year or two, and then get back to it. So I would also tell everybody that if you're buying something that's a value add property, you're purchasing a future value add project. And I would be telling my investors that, hey, this is a C space. It's something we're going to upgrade. We're going to raise the rents. We're going to do all that in 2 years. We're going to buy it today, but we're not going to do anything for 2 years. And then we're going to renovate when the market's a little better. So that's how I would be looking at any kind of value add type project. At Broadwell Property Group, my company, we're moving towards more the B space. Just, if we're going to overpay, and we know that we are because everybody is, we want to overpay for a quality building that has, good legs under it. It's going to be able to be a solid hold for a 7 to 10 year window without any kind of major capital expense surprises. And that way, the projections that we have will be more accurate. So that's kind of what we're doing, and kind of what I would tell people out there to do right now is be careful about the quick pop, big renovation, going to make $1 million in a quick amount of time, like you've seen all your friends do over the last 2 or 3 years. That's going to be a tougher business model. Buy, renovate, and refi. Also going to be a tougher business model today. It hasn't been, but it will be now. So we just have to learn how to shift our strategies going forward. And that's kind of what I'm telling our investors is, hey, the assets are going to look different, and they're going to produce different types of returns going forward.
Yeah. I think I appreciate you alluding to that, because I think what happens now is you're seeing so many new operators into the space. Syndication is the hot topic. It has been for a while, it seems like. But as you mentioned, this is not your normal. I feel like it's not the normal cycle yet, right? I mean, the behaviors that we've seen have been just really erratic, and just the urge to get into this multifamily space has been there. So you just got to be careful. You want to make sure that you're being prudent, that you're educating the investor, investor database, and just being transparent with them as where we're at right now. And we joke about this all the time, but no deal is better than a bad deal. And especially when you're raising capital from other people, it's a lot easier conversation to have versus we're not cash flowing and we can't pay out dividends. And, oh, by the way, we're going to get our butt kicked on this,
Yeah, which is even a better conversation than, oh, by the way, we have a capital call. Not only are we not cash flowing, we need you to put some more money in the deal. We're really in trouble. That's what we want to avoid. And that's kind of what I'm afraid is going to happen in the C space. You've penciled out, or what I call pencil whipped. Pencil whip your deals. That's just kind of making stuff work on a piece of paper. I think there's been a lot of pencil whipping going on, and blind eyes turned to interior costs and infrastructure costs. And so, I think that is what you're going to wind up happening. You're not going to get the cash flow you expected, and then you may even start to have capital calls. And that's where I'm predicting a softening in the market, and a bunch of sellers that are going to need some sort of exit strategy, where you just walking over to a bank, borrowing the money and writing them a check may not be that strategy. Then what? And that's where I'm predicting that there's going to be a lot of opportunity for buyers, not necessarily sellers, but buyers in the next 2 years going forward. Opportunity that has not existed over the last several years. Gotcha.
I don't wish anybody to fail. I hope that everybody can ride the storm out, but I am looking forward to that, those opportunities, because it's we've been beating up our head against the wall here for some time now. Just not to say we have the deal fever by any means, but
Sure.
It's hard when you're out there, like I said, you're analyzing deal after deal after deal, and you're just like, God, dude, how does this make sense to people? But
it doesn't make sense, and that's the problem. It's not a great time to quit your job and go full time into real estate unless you got a lot of real estate. So I would say pause that business plan, but it's coming. And so the whole point of me kind of penciling out all of these areas that are going to become problems are really areas of opportunity, if you know what you're doing. And so what I'm pointing out is that I believe a lot of the existing, the old guard in real estate now, or new, basically, since everybody's so new to the business, are there's a lot of mistakes made, and those are going to be exposed. And when they are, those people and owners are going to have problems, and those who can come along as buyers with creative solutions to those problems are going to be the ones that pick up the new portfolios and create their wealth going forward out of this sort of down economy. It definitely takes some skills to do it, because again, if your whole model is just, analyze a deal 20% down, 30% down, does the deal work? A lot of deals is going to be a flat no to that. And so how do you get those done? Well, that's where we're going to see a lot of opportunity in the market.
Well, that is a perfect segue into where I wanted to make sure we give you some time to speak to. In the midst of everything going on last year, you've been writing a book. I think it's getting ready to be released here pretty soon, called Creative Cash, which we are anxiously anticipating the release of. Tell us a little bit more about, the overall summary of the book, kind of what was the influence behind the book, and let's go from there.
Yeah, absolutely. So what this book is, Creative Cash, is a narrative of all of the skills that I learned by building my very first portfolio. So my first 402 units, I was able to get without walking into a traditional lender's office, borrowing money or getting a mortgage, put money down to buy the real estate. So I did all of it with some form of creative financing, from seller financing to lease options to help buying property with credit cards. I mean, every way you can think of, I've done it. And so this book is all of those techniques and strategies in an applicable format, in a way that you can go out and take these ideas and make use of them. And I always like to point out that, real techniques are only passed on by those who survive. I'm still here, and I went through the recession and I'm still here. And I used these techniques back then and it worked well. They don't work so well when the market is super hot. These are problem-solving techniques to help you have value that you may not otherwise have. All right. Well, if people don't have problems, do these techniques work? Not nearly as well. So over the last 5 or 6 years, you really haven't seen a lot of this stuff out there, because if a seller had a problem, they could probably just put the property on the market, sell it, get their price, move on, no problem. Well, this is what I'm saying. Hey, when those same issues of overpaying, of the CapEx tsunami, of all of this is going to be hyper exaggerated if lenders pull back. They already are. They always do. And so this creates a gap where you have a distressed asset, once called a value add asset. Now they were on the downside of the cycle. They call it a distressed asset. Well, it's just lender language. That's all that is. You know what I mean? So when the lenders like these deals, they're value add. And then when lenders don't like these deals, they're distressed assets. Well, we're moving into that distressed asset category. And so what you're going to see is lenders not wanting to fund, or they will fund, but under very heavy terms, these assets that have a lot of capital expense needs, that have low occupancy, that the tenants aren't paying rent, C-space stuff that's not top tier performance in its asset. And that seller needs to sell. Now what? Creative financing. And so that's what this book is. It's how to go out, how to look at deals, how to see a seller in a property, analyze it, see what are the problems that exist. And then here's a whole list of techniques that you can use to create an offer that solves your problems and the seller's problems and gives you value. Because that's the main point of the book, is to give you value that you may not otherwise have. Because you always have to have something to trade. If you've got no value to a seller, why is the seller talking to you? They're probably not, and so can you bring value to this individual? Yes, through creativity. Read the book. Here's all the techniques. How can you do a lease option, seller financing, debt partners, all these other ways that we're going to go out, find a distressed seller, solve the seller's problems. And I focus heavily on seller, not property. Real estate is 90% seller, 10% real estate. And if you've got the best property in the world, the seller won't work with you. It's a waste of time, isn't it? So it's really about identifying people and how to solve people problems that just revolve around real estate, which then gives you access to real estate you otherwise wouldn't have. And so it's a great way if you're not starting off with a lot of cash or a lot of experience. These are techniques that really help you get into the business. And hey, if you're an old dog in the business, I can teach you a new trick or two as well. So some different strategies you might be able to add in there. But that's roughly what the book is and what it's for. Again, it was 15 years worth of creative techniques put into one area. It's on Amazon, Audible, and Kindle. So you can get all three. It launches on February 9th. So as of the recording today on the 3rd, it's not available this second, but it will be on February 9th. So, hey, if you like the book, please leave me a review on Amazon. Apparently that's the whole thing is reviews. I'm new to this whole thing. I've never done this before. So that's supposed to get a bunch of reviews, I guess, but hopefully you like the book. Hopefully it helps everybody out there. It should be good.
Absolutely, Bill. Yeah, I think the timing on this book in particular is fantastic because of all the things we've already discussed. Look at where we're at in the market cycle. If you are going to a broker for a property, the chances of you having to overpay are really, really high.
Right.
Taking the techniques that are in this book and learning what does it mean to find a distressed seller, not just an asset, and how do you approach them with different tools in your tool belt, which is, when you go to a broker and you tell the broker right now on an on-market deal, like, hey, what about seller financing? They're going to look at you like you're crazy. So being able to, learn how to find these distressed assets and distressed sellers, and then be able to walk up to them confidently and not just apply the good old, I'm going to put 20% down, here's how we're going to do the deal. I think that's very valuable in today's market, and definitely something a lot of investors should be looking at putting in their tool belt. Because I know that's something that, we look at here is we don't like being what I call one-trick ponies. You can't just walk up and say, oh, it doesn't fit this box, I can't do the deal.
Exactly. And that's a great point, because creative financing is really only about probability. It's just increasing probability. So if you're looking at a set amount of deals and your only tool is to walk into the bank, put down 20%, get a loan, that you've got one trick, and most of the ponies are not going to work with that one trick. So instead of taking that deal and throwing it in the trash, I'm saying, hey, pull that deal back out of the trash. Let's apply a couple of these techniques, see if that alters the equation. If not, then it's a bad deal. Keep going. All creative financing is to increase probability of the identification of an asset that can be a purchase. That's it. I don't want people walking around thinking I'm going to do only lease options. I'm going to go find seller financing deals. No. You analyze deals like you would any old day. Here are just several other techniques to add to the toolbox. That's all it's for. So don't think it's a one way of doing real estate only. It is not. It's a really good point, Brian. It's just for increasing probabilities.
Yeah. I mean, it's great because, like you said, you have assets that may not work when you go trying to get a bank, obviously, but this gives, this creative financing techniques that, you've alluded to, you can kind of take control of those terms and you can create that win-win scenario. Right. And like I said, when you keep that focus on the seller and creating that win-win, that's where real opportunities present themselves. And you made this point too. I heard you mention this last year, and this is, Brian, to your point, this is why it's such a relevant timing right now is watch the behaviors of the banks. Your banks are your biggest capital partner in these deals, right? And they're usually the first to know when things are changing, and they're going to adjust before anybody else. And that's what you've already kind of mentioned already, is you're seeing some of those behavior changes already. So pay attention, because that's where these skill sets are going to become more applicable.
Absolutely. Yeah. Lenders are the key metric to watch. They're everything, they really control the market. That's all you have to do is watch lender behavior, and you can really predict what cycle we're about to go into.
Mm-hmm. Mm-hmm. So Bill, going back to, and we're talking about these creative financing techniques and whatnot, I think there's sometimes a negative perception of some of these strategies, and particularly on the seller side, right? I think sometimes the sellers, they're not as amenable to some of these ideas at first until you kind of open their eyes and show them, hey, this is how we can create this scenario. How are you kind of bridging that gap and helping the seller to understand that, listen, this can be a suitable strategy for the both of us? How do you get them to the table?
Yeah, well, the first step is knowing the techniques perfectly yourself. So if you don't understand the metrics of a lease option or master lease option, and you don't understand seller financing or debt partner, something, you don't understand these techniques, the likelihood that you're going to educate anyone is low. So my first comment, and it is a self-serving comment, read my book, but really go get an education in creative financing. Once you understand the techniques, explaining the techniques and or selling that kind of offer to a seller and or, by the way, realtor, it's even harder to go through a realtor. And I got a whole chapter on just how to do that. It's about finding out their problems. It's about, looking at the deal, looking at the issue, explaining to the seller why they have a problem. And there's the crux right there. If a seller doesn't realize they have a problem, they don't have a problem. So you may need to kind of sit down and I go through the entire process, sit down, analyze the deal, and find the areas of distress. Then we have to go back to the seller and say, okay, love you, love the property, love it, mean it, but that evil old lender over there just won't give me a loan. So, what do I do? Because, by the way, the problem that I'm identifying, it's not a me problem. It's an any buyer's problem. So you the seller, you see what I'm saying? It's not that Bill can't close. It's that Bill can't go to his lender and get a loan for that property for your price, which is a you problem, seller, not a buyer problem. And so it's that function of very gently educating the seller on the scenario, and then saying, okay, so I got an idea. Boom, here comes your creative offer. So see, through that process, you've gotten the seller ready. You've gotten this person ready for what it is you're going to do and what it is you're going to say. So that's where I find most people make mistakes in trying to use these techniques. They go in there and say, hey, here's an offer, seller financing. And it's the wrong approach. It's not that the offer was wrong. It was that your approach with the offer was wrong. And you're right. These kind of things, especially when a seller is looking for a straight purchase or sale of their asset, can take this as a negative. And it probably is if you're presenting it incorrectly. So it's not really the offer. It's the user. It's user error, right? It's the presenter. It's you that's probably the problem, not so much the technique. And so that's what I really, really spend a lot of time in the book, is showing you how to take personal approaches to people's issues, and then how to create that offer that is, a fit for the seller. And that's what I call the SPY technique. It stands for seller, property, you. That's a proprietary technique that we have in the book, and it teaches you how to kind of be a problem solver in that order. Start with the seller, then move to the property. Lastly, look at your own needs and issues. And that's a mistake. Most people kind of go the opposite direction. They say, what do I need? Oh, okay, let's see what the property needs. And then there's a seller involved, and that's kind of an afterthought. That's why most people fail with creative financing, is that one technique right there will help you tenfold.
Yeah, Bill, I think what people fail to realize sometimes is it's all about relationships, right? You might pick up the phone or cold call or send a mail or whatever to a seller on a property. They might take you 6-9 months, a year before you're finally at the closing table.
Yeah.
People want to sell essentially their baby. They might have owned it 10, 15, 20, 30 years or more. They want to make sure they're not just selling to some guy off the street who's just looking to make a quick buck. And, a lot of times real estate investors in general get labeled as, sharks, that we're just looking to take advantage of people and find a good deal. But when you follow that process you mentioned, and you really get to know the seller, build that relationship with them, let them understand a little bit about you and yourself and what you're trying to do as well, and see, what do they really want? Do they really want to just stick a bunch of money in their pocket? Or, do they want to avoid some taxes? Are they looking to ride off into the sunset and, go live somewhere else? You can really start to tailor the offering, the product that you're selling them, and, how you structure the debt based on what they're actually looking for. But I think, in your book, and I'm looking forward to reading it, I'm sure you talk about just being patient as a part of the process as well.
Absolutely.
You're not just going to walk in, be like, hey, my name's Bill, I'm a real estate investor, seller financing on the table. Here you go. Here's your pen, sign and go. That's not going to work.
Yeah, that's that run and gun technique. And that's you're absolutely right. That's a mistake. Everybody just wants this kind of shotgun blast effect of offers, just blast them out. No. Rifle effect. One very specific offer for a very specific reason. I don't like this just kite offers all over the place, and let's just see if anything sticks. That's unprofessional. It's a waste of time. It'll damage relationships, as you pointed out, Brian. So you want a very, very targeted technique, and don't be afraid to pass on a deal. Don't be afraid not to offer. If you don't bring any value in your offer, don't offer. And so that's a big one. But that's it. It takes a lot of deals. I've found, and I've mentioned before, that on average, through my experience, that people will close about 1 in every 80 deals that they analyze. So maybe with creative financing, we can get 3 out of 80, maybe 5 out of 80. It's just a numbers game. It's all it is. But you're only going to close 1 in X amount of deals that you analyze. So the key is deal flow. And that's the key to the business, is deal flow. You're just always out there analyzing deals. Most of them, as we know, not good deals, don't work for whatever reason. If every deal was a good deal, like I said at the beginning of the call, then our jobs are easy. That's just not true, right? And we know that's not true. So that's where I'm saying, hey, these techniques just increase probability. That's all.
Sure. Well, and as you're planting these seeds, and Brian, you alluded to this as well, it's a relationship business, right? And so a lot of these deals end up kind of coming back around some way, somehow, right? And so as you're building those relationships, even though it may not work now, you're presenting a seller with a seller finance option. They don't like it. They want to keep shopping, and they go around. A couple months later, they call you and Bill, hey, can we sit down and talk about that option again? You never know how the things kind of come back around. So just like you said, just keep building those relationships, just being transparent. And like you said, Bill, just it's timing, right? A lot of it's timing and relationship. So
you hit a really good one there, and I'll give everybody listening a tip. If one of the big things I would suggest right now, especially if you're going to do any sort of direct contact campaign, call it direct mail, but you're reaching out to owners or sellers directly. What I would try and do, and this is not that easy to do, but what I would try and do is track debt. If you can get a list, maybe it's through CoStar, maybe it's through Axiometrics, whatever, wherever you're going to go out and get your list, try and find sellers that have debt coming due within the next 18 months and put them at the top of your list of people to start building that relationship with. And you're absolutely right, Cody, it could take time. So if you're doing some kind of direct mail, direct, text, whatever kind of direct contact campaign, go and see if you can track debt. And when that debt originates, you can buy that data. It's not free, but you can get the data. But if you can, I would put those people at your very tippy top of people to build relationships with, because you're right. You may make that creative offer today, and they still have a lot of options. There's time on the clock, Yeah, but as they start moving towards that loan coming due, depending on where the market is, they may start to feel the heat of that sale, of a forced exit. And if their asset is distressed or the market shifts any, those are going to be the people that are going to be most sensitive to creativity first. So just track debt, watch debt coming due. Anything coming due in the next 18 months, jump on that, because those people might think they're going to go in and refinance and pull out a bunch of cash and all that. Not today.
Yeah, and one great resource that I think a lot of people like to use right now, it's pretty reliable for tracking that, is Reonomy. Is a great resource. Yeah, great. It's expensive, you're right, but you can definitely track those and get a good list of people that are coming due. So, but well, man, Bill, I think we can hold you here all day, man. This has been a fun conversation, man. This is awesome, man. Cool. And unfortunately, we're getting near the end of our time here. Sure. But before we go, I have a few more questions for you, and I can't recall if I asked you this last time, so we're going to do them again. So first and foremost, man, what do you like to do for your continued education to further your own investing?
Oh, I read constantly. 2 cups of coffee in the Wall Street Journal every morning, and then I read BizNow. Real estate news, BISNOW. It's a free online platform. So yeah, constantly read, constantly study. And then outside of just general, I've been studying more of the negotiation stuff lately. So, hey, I'll give a shout out to Chris Voss, Never Split the Difference. Great book. Don't know the man from Adam, but I think it's a great book. I think he's a great educator. Strongly recommend it. Good read. And that's what I've been spending a lot of time on, is sort of negotiation techniques.
Yeah, I'm glad you mentioned Chris, because I'm hoping to get him on the show. I'm gonna try to figure out a way, because it was a great book. You're absolutely
I'm a listener. I'm actually on my second read through it.
Oh, nice. Yeah, great techniques in there. But
I'll be on
so, Bill, so what have been some of the lasting lessons you've learned along your journey?
Lasting lessons. Failure is only a failure when it's repeated. So first time around, it's just a damn learning curve. Don't worry about it. I think people are too concerned with screwing stuff up and failing. I'm only concerned about repeating failures. First time around, write it off. And that took me a long time to kind of thicken my skin up and just get tougher in the business. So tolerating failure, I think, is probably one of the biggest lessons I've learned. And I notice when someone comes to me and says, hey, I need you to teach me real estate or whatever, I can't fail. I got to get it right. I can't help them. They're already failed. If you're not willing to fail, you've failed bigger than you realize.
Mm-hmm. I mean, that's where you learn that's where you grow the most, is through those failures, right? Through those mistakes. And so, yeah, I appreciate that. You said that so eloquently.
There goes.
All right, Bill, what advice would you give to listeners to help them grow their businesses?
Buy my book. Other than that, seriously, learn the human side of the business, and realize that business largely is within the eye of the beholder, not the asset, not the business itself. So it's really about personal skills. It's really about people skills and relationship skills. And you guys have repeated this in this call. real estate, especially all business, real estate especially, is a people business. I always think that's the stupidest comment. We say, oh, this is a people business. Show me a business that isn't a people business. Show me some business that's just two computers talking to each other. It's all about people. So you really got to focus on your personal skills and your problem solving skills. The best way to get successful in business is learn to serve. And I don't mean like charity wise, but I mean, make your business bring value to others by solving problems. Problem solving is probably one of the highest paid skills that I've ever come across.
Mm-hmm. And it's probably one characteristic that separates those who are successful in the space than those who are not, right? Like you mentioned this earlier. If you can't solve a problem, if you're a one-trick pony, you're not going to get very far. But awesome, man. All right, Bill, well, listen, tell the listeners how they can learn more about Broadwell Property Group. Where can they find your book, and tell us how they can get connected with you?
Absolutely. Yep. Again, it's Bill Ham, and I'm the COO of Broadwell Property Group, and you can go to broadwellpropertygroup.com. If you want to invest with us, we have a space there. You can go in and fill out your information. We'll be in touch with you shortly after. So if you're looking to do business with us, broadwellpropertygroup.com. The book is on Amazon. It's Creative Cash. It's on Amazon, Audible, and Kindle. And that's Ham with one M. So if you're looking for me, go there. And then we also have a home study course that is downloadable, and it's at creativeapartmentdeals.com. You can get the book there, or you can get the book and the home study course. Again, creativeapartmentdeals.com. And if you want to reach out to me personally, it's bill@gobroadwell.com.
Awesome. Bill, great conversation. Really appreciate your time again today. And thank you so much for tuning in.
Hey, always a pleasure, man. I look forward to next year. I'll be back.
Appreciate it, Bill.
Absolutely.
Thank you. Take care.